Nikkei 225 just shed 1,741 points in a single session. That's a 2.47% freefall, and the street is screaming risk off before US payrolls. But right here, right now, there is one danger zone and one hidden opportunity that the herd is completely mispricing. I'll show you both in the next 12 minutes. On screen right now, you're seeing the number that decides everything. 68,132. Write it down. This level is a trap. Either it snaps and we free fall into the abyss, or it holds and we get a melt-up that crushes late shorts. I'm giving you 2 scalp plays and 1 swing trade you can execute today. Stay to the end, because the final 2 minutes will hand you tomorrow's wildcard that could change the entire monthly trend. MY session bias. We are officially range-bound with a vicious bearish lean, but a violent mean reversion bounce is building right underneath the surface. The invalidation level that flips everything is a daily close below 68,132. If the Nikkei closes below that today, the weekly strong buy structure fractures into neutral. That's the line. Right now, the herd is piling into shorts, expecting payrolls to deliver another risk-off flush. But here's what they're missing. The Japanese yen is quietly weakening against the dollar. US dollar to Japanese yen is holding above 146, and every tick higher in that pair is a direct profit injection for Nikkei exporters. While the panic sellers are staring at the red candles, the fundamental floor is being poured right beneath us. That creates the exact condition for a stop hunt and a rapid squeeze. Your first interaction. Write this number down. If we print a daily close below 68,132, the entire structure resets. I'll say it again, 68,132. Burn it into your screen. Let's walk the charts from the top down, because what's happening across the timeframes tells you exactly how the big money is positioning. Zoom out to the monthly and weekly first. The monthly trend is a strong buy. Price is over 11,000 points above the 200-month moving average, and we are still carving higher highs. The weekly trend is also a strong buy. On the weekly, every moving average, the 20, the 60, the 200, is sloping up and price has been riding the 20-week MA like a rail. The daily, however, has cooled to neutral. And this is the sweet spot. We are currently trading right at 68,733, which is just below the daily 20 moving average at 68,995. But look what's below us. The 50-day moving average at 65,986, the 100-day at 62,431, and the 200-day at 57,167. That's a textbook bullish alignment. Price is pulling back into the gap between the 20 and the 50, within a roaring uptrend. This is where institutions reload. Now the momentum picture. Daily MACD is at 943 and starting to curl lower, but notice it's still positive. That tells you this is a correction within a bull trend, not a reversal. ADX is at 22, extremely weak trend strength on the daily, confirming it's a choppy, corrective environment. RSI sits at 51, dead neutral, no extreme yet. This is not a crash. It's a position squaring event before a major news catalyst. Drop down to the 4-hour chart. Here, the trend is decisively sell. Price is beneath both the 4H20 and 60 moving averages, which are now acting as dynamic resistance near 69,269,500. The MACD on the 4-hour is accelerating bearish, and that's why the sell-off has been so aggressive. But there's a hidden signal that most traders will completely overlook. The stochastics on the 4-hour are reading an insane 94. They are still massively overbought after a 2.5% drop. Think about that. The market was so overstretched to the upside that even this sharp sell-off hasn't burned off the excess. That tells you this is a purge of weak hands from an overextended rally, not the start of a structural collapse. And the 1-hour chart is a strong sell. Price is making lower lows. The 1-hour 20 and 60 MAs are cross bearish, and MACD is deep in negative territory. That's the short-term pain. Now, here's the level that separates winners from losers. Key supports. S1 at 68,132. That is the immediate pivot floor. S2 at 67,129, and S3 at 65,214. On the resistance side, R1 at 71,050, R2 at 72,965, and the psychological magnet at 70,000. The pivot point for today sits at 70,047, which means as long as we are below that, intraday bears have the steering wheel. Here's what most traders miss. While everyone is watching the red candles and the chipmaker headlines, there is a massive divergence brewing between the Nikkei and the yen. I just checked the US dollar to Japanese yen correlation. The daily correlation coefficient is deeply positive, meaning a weaker yen equals a higher Nikkei. And right now, the dollar yen is inching higher even as the Nikkei drops. That's an inefficiency. It tells you the sell-off in equities is sentiment-driven, not flow-driven. The yen hasn't strengthened enough to justify a 2.5% collapse. This is fear. And fear gets bought, especially when the underlying driver, the Bank of Japan's ridiculously loose policy, keeps the yen on the back foot. The same article that hit the wires today outright said Nikkei 225 supported by weaker yen as technical test looms. The market is whispering the exact opposite of what the price action is screaming. That's a trap. Keep this divergence in the back of your mind when we get to the liquidity grab. The core news catalyst today is the Asian chipmaker rout dragging the Nikkei 2.33% lower as US payrolls loom. Tokyo Electron, Advantest, they got hammered. But here's the reality. The US non-farm payrolls report is tomorrow. What we are seeing is a classic pre-event de-risking. Funds are cutting exposure to avoid the gap risk, not because of a structural bearish shift. And once that event passes, the real trade emerges. The macro web is critical. If US payrolls come in hot, the dollar strengthens, the yen weakens further. That's instant fuel for Nikkei exporters. If payrolls miss badly, we might get a risk-off scare, but the Fed rate cut narrative would explode, weakening the dollar eventually and also supporting equities. The 2-week directional lean I'm working with is this. As long as 68,132 holds on a daily closing basis, we are targeting a bounce back to 71,000. I see a coiled spring. The invalidation is a daily close below 67,000. If that happens, the weekly structure would flip neutral and would likely test 65,200. Second interaction trigger right now. Do you think the Nikkei will close above 70,000 this week? Drop a yes or no in the comments. I'm tracking the community consensus, and it's usually beautifully wrong. Type it now. Most people skip this section. That's exactly where the money is made. Keep watching. I'm handing you 2 scalp strategies and 1 swing strategy, with exact triggers, exact stops, and exact targets. No guesswork. Strategy 1, the opening scalp, short, counter-trend fade. The 1-hour chart is a freight train lower, but every train pauses at a station. That station is the 5-minute order block at 68,950. As the Nikkei digests the initial plunge, short-term shorts will cover, driving a mechanical bounce into this resistance zone. Here is your setup. The trigger. Price taps 68,950 and prints a bearish engulfing candle on the 5-minute chart. The moment that 5-minute candle closes red and engulfs the prior green candle, you enter short at 68,930. Your stop loss goes at 69,050, exactly 10 points above the psychological 69,000 level and just above the 1-hour 20-period moving average, which will be capping the bounce. That gives you a tight 120-point risk. Take profit 1 is at 68,750, a quick 180-point scalp, a 1 to 1.5 risk reward. If momentum carries further, take profit 2 extends to 68,500. What instantly voids this scalp? If the 5-minute candle closes above 69,000, the reversal strength is too high. Abort immediately. The opening scalp, entry, 68,930, 5M bearish engulfing after tap of 68,950, stop loss, 69,050 take profit 1, 68,750 take profit 2, 68,500 risk, reward, 1:1.5R, TP1, invalidation. void if 5M candle closes above 69,000. Strategy 2, the liquidity grab, long, counter noise. Now, this is the real moneymaker, and it requires rapid execution. The herd stops are sitting right beneath 68,132. Smart money knows this, and they will engineer a stop hunt. We want to see a swift, violent spike through S1. Price shoots down to the 68,000, 67,950 region, wicks, and then immediately snaps back. That's the grab. Your trigger, price breaks below 68,132, wicks to 67,950 or lower, then a 5-minute candle closes back above 68,132. That confirms the rejection. Entry long at 68,180. Stop loss at 67,900. Tight, just below the wick low. Target, the nearest intraday liquidity pool at 68,600, which is the breakdown point of the 1-hour opening range. That's a 420-point snipe, risk-reward near 1 to 2. Warning, if price just grinds through 68,132 without the sharp snapback and the 5-minute close above it, do not enter. The trap has failed, stay flat. T. Liquidity GRAB entry, 68,180, 5M close back above 68,132 after wick below, stop loss, 67,900 take profit 1, 68,600 risk, reward, 1:2.0 invalidation, no 5M close above 68,132, grinding lower invalidates right here, interaction cliff. Are you scalping or swinging this week? Comment scalp or swing. I want to see where this community sits. Drop it now, I'll read every one. The session swing, long, trend alignment. This is the institutional play, aligned with the daily and weekly strong by structure. The weekly chart says every dip is a buying opportunity. We don't try to catch the exact bottom. We wait for confirmation that the correction is over. Our swing trigger. We need a 4-hour candle close above the 4-hour 20 moving average, which is currently dynamic around 69,100. But we add a momentum filter. We also want to see the 4-hour MACD histogram tick higher and a bullish cross of the MACD line above its signal line. When that happens, likely after the liquidity grab or a daily hammer, you enter long at 69,150. Your stop loss goes at 68,700, below the day's low and beneath the S1 support, giving the trade room to breathe. Take profit 1 sits at 70,050, the daily pivot point and a magnetic round number. That's a 900-point runner, risk-reward 1 to 2.2. Take profit 2 stretches to 71,050, the R1 resistance and a weekly breakout point. That's a 1 to 4.7 risk-reward. Trailing stop rule. Once price reaches 69,800, move your stop to break even. The medium-term outlook only flips bearish on a daily close below 67,000. That is your invalidation. The session SWANG entry, 69,150, for H close above 20 MA plus bullish MACD cross, stop loss, 68,700 take profit 1, 70,050 take profit 2, 71,050 risk, reward, 1:2.2R, TP1, 1:4.7R, TP2, invalidation. Daily close below 67,000. Never risk more than 1 to 2% per trade. Scalps demand even tighter risk. I keep my scalp risk under 0.5%. No positions through high-impact news like US payrolls. Stops are non-negotiable. The moment you let one run, you're gambling, not trading. This is how you survive to trade the next big move. The single most critical level for the next session is 68,132. If that holds, the melt-up is alive. If it breaks on a daily close, the whole monthly trend comes under pressure. Tomorrow, the US non-farm payrolls will hit. That number could either accelerate this breakdown into a full-blown freefall or ignite the rally we've just mapped. I will have the updated blueprint exactly 24 hours from now. If that level breaks, the monthly trend flips. Don't miss it. If you want the full breakdown on Bitcoin and the S&P 500 divergence, that video is live now. Tap the end screen and let the algorithm know you want more. Then hit the bell so tomorrow's alert lands before the Tokyo Open. Hold the like button and subscribe. Every signal you send tells YouTube to push these levels to more traders who need them.